Hey, how's it going, everyone? Let's go ahead and talk about Hormel, the pepperoni company. In this video, we are going to look at the intangibles, the finances, and run some valuation models to determine if it's a delicious or disgusting dividend stock. Ah, nuts. All right, so as of right now, Hormel is trading for about $33 a share, and their trading multiple is around 22.8. About a year ago, Hormel used to trade for about $40 a share, and since then, Hormel has been on a downward spiral. But is this justified? Did Hormel deserve to be punished like this? But before we try to answer that question, let's go ahead and look at the Fear and Greed Index to figure out what's driving the market now. So on a scale of 0 to 100, it is a 77, which means the stock market is being propped up by extreme greed. I look at this as optimism because back in October, the scale was a 22 out of 100, meaning extreme fear was in the market, which meant for me, I saw buying opportunities everywhere. So it was a good time. Hormel is in the business of protein. So for you athletes and in general, people who work out, their foods are important for the gains. If you want to recover faster and see muscle progress, protein is important to be a part of your diet. Jokes aside, Hormel is in the business of canned food, turkey meat, bacon, and peanut butter, as you should see Skippy on your screen. And I'd even argue that Hormel is the much better alternative to Kraft Heinz. And I want to call this out because it's important. Hormel has a long history of consistent dividend growth, 57 years, through the ups and the downs, even through the dot-com bubble, the Great Recession, and the pandemic. Hormel also has strong fundamentals on their balance sheet, although last year wasn't too hot. Because of their finances and balance sheet, their trading multiple is a little higher than their industry peers. So Hormel has a modest PE ratio of about 21. In contrast, Kraft Heinz has a PE ratio of 15, and Campbell is around a 16 PE ratio. Their dividend yield is 3.7%. Their dividend payout ratio is 77%. And I know the color is red, but I don't think it's that high. For a mature company, I think it's okay. For instance, if their payout ratio was hovering at around 90% or above, then I would say it's in the dangerous category. They have been increasing their dividend for 58 years. Some of you aren't even 58 years old. They've been increasing this dividend longer than you've been alive. And they're growing their dividend at a rate of 5.7%. So in 2015, they paid out $1 per share in dividends. And the reason why this number is low in 2023 is because back in 2016, Hormel implemented a 2-for-1 stock split. So if we do reverse math, their dividend payout should realistically be $2.20 in 2023 if that stock split never happened. And now it's Hormel with $10,000. 10 years later, the final balance would have been 16.5 grand. This spits out a CAGR of 5.1%. During their best year, they went up by 54% back in 2015. However, during their worst year, which was last year, they went down by negative 27%. So let's go ahead and look at Hormel's investor presentation. So Hormel just posted their 2024 Q1 earnings, and they absolutely crushed the revenue expectations and EPS estimations. The stock actually rallied by like 15%, which shows the market has low expectations for value stocks like Hormel. But if value stocks like Hormel shocks them in a good way, they get elevated like a dancer's high heels. Oh, I'm so sorry. I meant 15% as in like right here. So the first quarter key messages. Hormel delivered strong results, led by better than expected performance in each of our segments. Volume, net sales, adjusted diluted net earnings per share, and operating cash flow increased compared to prior year. Hormel is reaffirming their full year guidance, expecting continued growth in everything and everywhere. And what is interesting about this earnings report is that their Planters snack segment, which is the peanuts, it grew a lot more than they had forecasted, but it makes sense. Peanuts are a healthy snack that's also high in protein and a better alternative to potato chips because they have that crunchy factor. You know what I'm saying? Sometimes late at night, you just want something in your mouth that doesn't have to necessarily be a pee-pee. And I don't know about you, but popcorn, peanuts, chips, they all sound pretty good. When I used to do bodybuilding, schooling. I don't anymore, but when I used to, I would snack on Planters peanuts in the evening when I was hungry. My favorite flavors were sweet and spicy and also the honey roasted one. And I think as more and more people become cognizant of their health, snacks like peanuts are going to be winners going forward. And this right here is really good news because the turkey business was weighing down the Hormel portfolio last year. However, they grew their retail volume and sales, which means that the Americans enjoy eating that turkey again because it's an alternative to eating chicken all the time. The first quarter financial metrics, year over year, as you can see, there's the tiniest bit of growth, but that's to be expected of a mature company with a solid and consistent dividend, and because they're maneuvering through inflation times. So their operating costs, logistics, the cost of their goods sold, everything is a lot higher. With that said, Hormel has confirmed their 2024 full year earnings guidance at a low of $1.43 per share and a high of $1.57 per share, which means that the dividend is safe. The dividend is absolutely doable on paper because the payout is only $1.13 per share. And now, my most favorite part of the video.
Well, intrinsic value, in other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about.
We are going to run some valuation models to derive an intrinsic value for Hormel, and then we're going to compare that number to what the Wall Street analysts believe the price target should be. And then we can finally figure out, is it a delicious or disgusting dividend stock? So the first one is going to be the multiples valuation. Essentially, we're going to be looking at peers in the same industry as Hormel to see what the median PE ratio is. So we're looking at Kellogg, Kraft Heinz, Campbell, Pepsi, Coca-Cola. The median PE ratio is 24.1. Taking that into consideration, that spits out an intrinsic value for Hormel, $34.95 a share. And remember, they're trading for about $33 a share right now. So this checks out. The next one is going to be the discounted cash flow analysis model. Basically, we're going to derive an intrinsic value for Hormel based on their free cash flow growth. So back in 2018, they posted $862 million. The next year, they went down by negative 22%. However, right after that, they went back up by 14% and then only by 1.2%. And then they went up by 11% and then they went down by negative 8%. This is really inconsistent, I know. However, for the next 5 years, the analysts are projecting that the growth rate will be 8.2%. So when we plug that in alongside with some balance sheet numbers, that's going to give us a DCF price of $28.92 a share for Hormel, which makes sense because when you look at their 52-week range, their low was $28.51 a share. So $28.92 does not sound outrageous. Next is going to be the dividend discount model. Essentially, we're going to figure out the intrinsic value based on their dividend payout and dividend growth rate. So back in 2019, they paid out 84 cents a share in dividends. You fast forward throughout the years, and yes, it has been growing, and currently the dividend payout is sitting at $1.13 a share. This gives us an average dividend growth rate of 7.71%. However, that's a little optimistic to plug into the formula. For me, that is. So we're going to shave off about 1.7% and plug in a 6% average dividend growth rate going forward. Taking that into consideration, that gives us a DDM price of Hormel $59.89 a share. And next is going to be the Benny Graham's valuation model. Essentially, we're going to reach an intrinsic value based on the growth rate projection alongside with the current AAA corporate bonds yield rate. When we take all of those numbers, plug it into this formula, that gives us a Graham valuation of $19.91 a share, which brings us to the conclusion. We're gonna figure out, is it a delicious or a disgusting dividend stock? Okay, so the intrinsic value is going to be $35.92 a share. Let's go ahead and see what Wall Street has to say. So Wall Street believes the price target of Hormel should be $36.43 a share, a low estimation of $28 and a high of $47. So we said $35.92 a share. Wall Street says $36.43 a share. That's pretty close and accurate. So after hearing everything, you're kind of interested in Hormel, but you're trying to figure out what is an acceptable buy price. Well, let's do that together. So we're going to go ahead and say that the current trading price is around $33 a share, with a 10% margin of safety baked in.
That margin of safety concept boils down to getting more value than you're paying.
Then the acceptable buy price becomes $32.33. With a 15% margin of safety baked in, then the acceptable buy price is $30.53 a share. If you buy Hormel right now at its current trading price of about $33, then the margin of safety that you get is 6%. So what is my opinion about Hormel after looking at everything, the numbers, the finances, and the dividend profile? I think Hormel is a solid CPG stock. I don't think it's going to be an Apple or Microsoft in terms of performance for the next 5 years, but their 3.5% dividend yield seems safe and solid, and the history proves it, right? They've just consistently been paying it out and consistently been growing it. Their balance sheet also looks great. In terms of valuation and price target, I think whenever the company reaches $30 a share or a little lower, that would be my buy-in price. So we're talking about like $29.50, $30 a share, something like that. I would go as far as to say that Hormel is a delicious dividend company. Not as delicious as in Domino's or Texas Roadhouse. Delicious in that it's just an overall good company. They're not spectacular or excellent in any criteria. And their dividend history just makes me feel good about the 3.5% dividend yield. You know what I'm saying? Like it feels safe. It feels steady. Is that a fair assessment of Hormel? Well, that's all I have for you today. Please do your own due diligence and research to figure out if Hormel is delicious, because to me, I think it is. It's more of like a B- type of delicious. It's good. It's better than average, but it's not in the excellent category. Anyways, I'm gonna go ahead and eat my breakfast with Hormel pepperonis on my eggs. Good morning, good afternoon, and good night. Dividend compounders with cheese signing out. Stay safe, everyone.